Hi, it's Larry Gaines from Options on the Open. At Options on the Open, we are the leaders in option day trading. But our service is not just about day trading using options. We offer much, much more. You see, I've been a professional trader for over 25 years, and for over 10 years of my trading career, I ran the international trading desk of one of the largest oil trading companies in the world. I have an abundance of trading ideas, skills, and knowledge that I bring to the service, and one of my goals is to teach and pass on to my members as much of this as I can in order to make them not only better option traders, but better traders, period. So Options on the Open is now a more complete online trading site for its members. We still concentrate on day trading using options, but we also do a lot of option swing trades as well as other option strategies. When I have a trading idea, I put it out to the members and explain my reasoning for the trade, the fundamentals and technicals of the trade, and then I teach them how to make the trade and manage it. I try to make the Option on the Open live trading desk just like one at a hedge fund, where you table your trading ideas, analyze them, analyze the risk-reward profile, and then trade it or can it. One such trading idea that I threw out at the end of December 2010 was an Iron Condor on Netflix. Don't you just love that name, Iron Condor? It just sounds really cool to me. Now, an Iron Condor is a real favorite of hedge funds. In 2009, I started an over-the-counter crude oil option brokerage desk in Houston, Texas for a company called PVM Oil Limited. PVM is the largest privately owned crude oil brokerage company in the world, and it is a huge player in the OTC or over-the-counter crude oil option market. Well, I'll never forget one trade that we brokered, and it was an Iron Condor on crude for one of the largest commodity hedge funds in Europe. In one day, we were able to put together for them an Iron Condor in the over-the-counter crude oil market of over 14,000 contracts of crude oil, which we posted to their account on the NYMEX exchange. Now, one NYMEX oil contract represents 1,000 barrels of crude. So 14,000 contracts was 14 million barrels of crude oil with a notional value at the time of over $980 million based on $70 crude. The point of this is that at Options on the Open, I teach our members trading strategies like this, but on stocks and obviously at a much smaller scale. So here's the trade we did, and it was on Netflix. I got the trading idea from a Barron's article on Netflix, that's NFLX, in their December 27, 2010 issue. In summary, the article made a case that Netflix profit margins would come under pressure due to increasing cost of content. If you are familiar with this stock, you would know that it has been on a tear to the upside and had traded up to over $209 per share. Well, this article threw a bit of cold water on the stock and stalled its upside momentum. This became the perfect scenario for an Iron Condor. Now let me give you a quick explanation of what an Iron Condor is. The Iron Condor is a limited risk, non-directional option trading strategy that is designed to have a large probability of earning a small limited profit when the underlying security is perceived to have low volatility. Its strategy can also be visualized as a combination of a bull put spread and a bear call spread. Using options expiring on the same expiration month, you create an Iron Condor by selling a lower strike out of the money put, buying an even lower strike out of the money put, and then selling a higher strike out of the money call and buying another even higher strike out of the money call. This results in a net credit to put on as you put the trade on. The maximum gain for the Iron Condor strategy is equal to the net credit received when entering the trade. Maximum profit is attained when the underlying stock price at expiration is between the strikes of the call and the put. At this price, all options expire worthless. It is basically a play that option volatility will stay low, and you let the time decay of the option work for you by having the options you sold expire worthless. Well, as you can see on this chart, the stock has been trading sideways ever since, well, for about the past month. Here's when the article came out, right here, December 27th. Put the trade on the following day on that Monday on I believe it was the 28th, and it's been pretty much sideways ever since. Now the trade was this: sold the credit call spread, a 220 call here, and bought the 240 call, received $82 per contract. On the downside, we sold the 145 put, bought the 135 put, received $25 per contract. So the total trade credit received was $107 per contract. Well, as you can see, the key to it is putting your limits or your collars far enough above the prices where it's currently trading, where you're not going to get called out at expiration. Now, expiration is this coming Friday, so we're looking pretty good right now. So if you would like to learn how to trade options, please join us at optionsontheopen.com. That's optionsontheopen.com, and thank you for your time.